It's never been easier to build a long-term stock portfolio thanks to ETFs. ETFs have made it easy for anyone to enter the market and start passively investing without having to worry about picking individual stocks. Not sure what an ETF is? An ETF is an exchange-traded fund. In other words, the best way to think of an ETF is a bunch of stocks combined into one stock. There are all types of ETFs out there in the investing world. Some ETFs are complex, such as ETFs that use derivatives, and some are very simple, such as ETFs that replicate index funds. So today I wanted to make a quick YouTube video that just discussed some of the most popular ETFs that are commonly used to build a set it and forget it portfolio or just a passive investing portfolio. Since everybody who is watching this video likely has different investment goals and different risk tolerances, this video is only intended to be used as an educational resource. Some of you might prefer to invest in one single ETF, while others might prefer to invest in a mixture of ETFs. That decision is ultimately up to you to make based on your personal investment goals and your risk tolerance. I can't answer that without knowing your entire financial situation and your personal risk tolerance. So for the sake of this video, I did my best to include both the pros and the cons for each fund we're going to talk about. That way you can make a decision based on your personal financial situation. That being said, let's dive in. Okay, so the first fund we're going to talk about is VO. The main goal of VO is to track the performance or kind of mimic the performance of the S&P 500 index. And the fund does this by holding the top 500 largest companies in the United States. And this fund has a 0.03% annual fee. That being said, let's go ahead and talk about the pros of VO. So this fund has historically earned around 10% per year, some years less, some years more, since the day of its inception. The S&P 500 index is one of the most widely watched indexes around the world, and it's typically used to gauge how the overall US stock market is kind of performing. Since 1980 specifically, the S&P 500 index overall has returned a little bit over 10% per year. So VO is a great fund for those who want to have exposure to the overall United States economy and the growth that comes along with that. Now let's talk about some of the cons. So one of the biggest cons to VO is that all of the companies within the fund are US based. So you don't necessarily get any direct international exposure. Although all of the companies are US based within the S&P 500, most of those companies do operate in international markets. It's actually estimated that S&P 500 companies get around 40% of their revenue from outside of the United States. But if this is a concern to you about not having enough direct international exposure, you might want to add on an index fund that has international companies. Additionally, all of the companies within the S&P 500 are larger companies, so there's no exposure to any small sort of companies. All right, next up, we're going to talk about VTI. VTI is a total US stock market fund, and the goal of VTI is to track the overall broad exposure of the US stock market. So unlike VO, VTI actually has some exposure to mid-size and small-size companies as well. The fund has over 4,000 companies within the fund and has an expense fee of 0.03%. So this fund is very similar to VO. One of the biggest pros is that it includes exposure to mid-size and small-size companies. So if you want broader exposure to the overall US stock market, VTI would be a great fund for you. Let's jump into the cons real quick. So although VTI does include mid-size and small-size companies, the fund is still dominated by the larger companies in the fund. Almost 25% of the fund is made up of these 10 stocks here, which is very similar to VO. So because VTI is dominated by larger companies, even though it includes smaller companies, the fund is still completely dominated by larger companies. For that exact reason, the historical performance of VTI has been nearly identical to VO because both of the funds are dominated by larger companies. So yes, you'll still have some exposure to small companies and medium-sized companies with VTI, but if that's really what you're after, you might be better off adding additional exposure to those type of companies directly. Okay, and the next fund we're gonna talk about is QQQ. QQQ tracks the NASDAQ 100. So of course, it only holds 100 stocks within the fund. The fund has a 0.20% expense fee. And I would say QQQ is great for those who are looking to take more of an aggressive investing approach. QQQ only holds non-financial stocks within the fund. So naturally, the fund is going to be dominated by tech stocks. QQQ has also historically outperformed the S&P 500 over longer periods. Some of the biggest cons or drawbacks to QQQ is that QQQ is a lot more volatile compared to the S&P 500. So if you don't have the stomach to deal with that additional volatility, QQQ might not be a great fund for you. Also, the expense fee is 0.20% per year, so that is a little bit on the higher side when you compare it to VO, but it's still reasonable relatively speaking. I personally think QQQ, like I said earlier, is great for those who want to take a more aggressive investing approach. QQQ is actually one of my favorite funds to actually invest in. And I think if you are younger and you have a longer investing horizon and you're okay with that additional volatility, I think QQQ is a great addition to your portfolio. Okay, next up, we're going to talk about VUG, which is a Vanguard growth fund. And as the name probably gives away, the goal of VUG is to invest in larger growth companies or growth stocks. The fund has 274 companies within it and has a 0.04% expense fee. So this fund is concentrated in larger stocks that have high growth potential. So if you're looking for concentrated exposure into larger high growth stocks, this fund would be great for you. One of the big drawbacks when it comes to VUG is that I would say it also has, just like QQQ, more volatility to it. Additionally, this fund is only invested in larger sized growth stocks, think Facebook or Tesla. So if you're wanting exposure to smaller growth stocks that might have more growth potential, you might want to look into a different fund. Okay, next up, VWO, which is Vanguard's Emerging Markets ETF. And the goal of this fund is to combine a bunch of stocks from different emerging markets around the world, excluding South Korea though. This fund actually holds over 4,000 companies within the fund and has an expense fee of 0.10% per year. So this fund, I would say, is great for those who want to kind of hedge against maybe their local economy, like if you live in the United States and you want to have some exposure to other emerging economies to kind of diversify your portfolio away specifically from the United States. This fund would be great for you. Emerging market economies tend to have a much higher potential for growth. As seen in this graph right here, this fund includes stocks from all of the top emerging markets with the highest growth potential, such as Hong Kong, Taiwan, India, China, Brazil, South Africa, Saudi Arabia, Russia, Thailand, Mexico. So all of the top emerging markets around the world, they're all kind of included in a basket within this fund. So let's talk about some of the drawbacks when it comes to this fund. So although emerging markets have a higher chance for growth, that also comes with a higher chance for risk as well. And there's several different types of risk in emerging market stocks. So as you might guess, since these are emerging economies, they are not usually as stable as developed economies like the United States. And this is due to a few reasons, such as currency risks. So the currency might have more volatility to it, political risk, and liquidity risk as well. So although future economic growth might be higher in emerging market countries, there is also higher risk that comes along with that. So just something to keep in mind if you plan to invest in these sort of funds. Okay, and next up, we're going to talk about VT, which is Vanguard's Total World Fund. And as the title of the fund kind of gives it away, the goal of this fund is to include stocks from all around the world, developed economies and emerging economies, and just combine them all into one big basket of stocks. So naturally, this fund has a lot of stocks in it. It has over 9,200 companies, 9,200 companies within the funds, and has a 0.08% expense fee. So this fund is a well-diversified fund and covers economies from all around the world. So if you're looking to invest in the overall global wealth, this fund would be great for you. Here's a quick breakdown of the top 10 economies that this fund has exposure to. One of the big drawbacks when it comes to this fund is that although it's well diversified, that diversification comes at a cost. So this fund has historically underperformed the S&P 500, as seen in this next chart. Nonetheless, this fund could still be a great addition if you're looking to hedge your portfolio against political risk and economic risk in the United States. So let's say you're an investor in the United States and you're unsure of the future of the United States specifically. VT could be a good fund to add to your portfolio just to have some additional exposure to economies around the world. Okay, and lastly, we're going to talk about VB, which is Vanguard's small cap fund. And VB's main goal is to combine all of the smallest companies that are investable into one fund. There are over 1,500 companies within this fund, and VB has an expense fee of 0.05% per year. So VB is going to be great if you're looking to add some additional exposure to smaller companies. This fund captures the US small cap space very well. Smaller companies are generally considered much more riskier, but also tend to have more upside potential. So let's say you're invested in the S&P 500, but you also want to have some additional exposure to like smaller companies. This fund could be a great addition to add to your portfolio to kind of build out a more broader exposure to the US stock market if that's what you're looking to do. The biggest drawback to this fund is that it's only invested in US small cap companies. So because of that, it's considered very volatile since smaller companies tend to be volatile. As seen in this chart right here, this fund has historically underperformed the S&P 500, and that's just because it has smaller companies within the fund. So a lot of those smaller companies might either go bankrupt while only a few are going to have that upside potential that we talked about earlier. Well, that's it for today. I hope this quick video kind of helped clarify any confusion around certain funds that you might be considering. Keep in mind that there's an ETF for almost every single index or industry out there. If none of these funds match what you're kind of looking for, you can always just do a quick Google search of any industry or index you want to track into your portfolio, and I can almost guarantee you that there's going to be some sort of ETF out there that will match what you're looking for. As always, thank you so much for watching. Have a great rest of your day.